Hey everybody, welcome aboard. It's about 7:59 East Coast time. Looking forward to getting started here. I'm just going to go over, we'll start with some questions that have been asked to me while people are jumping on board. I was interviewed for a podcast today by a lady named Sarah Grillo, Grillo, Sarah Grillo. So it'll be interesting. I'll post that podcast when it comes out. There's more for, what's up, Lauren? Lauren, where you cut right in from, my man? And Sarah, is more geared towards financial planners and financial planners who are budding financial planners. She did an interview with me, but she writes a lot for Advisor Perspectives. Right on, Arizona, CB, AR10, precious metals of brass and lead. Yes, sir. And so that's good. I very much enjoyed having a discussion with Sarah. Advisor Perspectives is a wonderful resource, by the way. Hey, Steve, where are you calling from? It was 939. Imagine that's your area code. Where's that? Hey, Franklin, watch this until the game starts. Yeah, no, I don't plan on being here. Was it first up? Is the tip off at 9:20, I believe, right? So who are you going for, Franklin? I predict Texas Tech, New Jersey, right on. Texas Tech will win 63-58. Cheryl from Texas, right on. Doug and Carl from Texas, yep. So you heard it here first. Texas Tech, 63-58. Defense wins, man. I think UVA's got a pretty good defense too, but I got some SEC homers on my Facebook page. They're like, the SEC got robbed. I was like, no, man, they got fouled. They had a jersey before the guy double dribbled, but it definitely was a double dribble, that's for sure. What's going on, Martin? Right on. So Tech, yeah, that's what I think too. Texas Tech, and we'll see what happens. Anyway, so I want to get started with we'll just start with some questions here. By all means, fire away if you like. Actually had a lady, Carol, who's talking about my shoulder, by the way, and she says cortisone injection or a derivative of it will probably be a shot I get tomorrow when I go see my doc. But she says she's a bodybuilder and she's a physical therapist, I believe. She says, do not stop exercising. So if you got a Tennessee, right on, Jude's 121. So she says, if you got an injury, just whatever you do not stop exercising. Do exercises that do not involve your rotator cuff. There are many parts of the body, legs, abdomen, back. If you exercise and are physically fit, you let the medical doctor know you're not depressed and know what your body pain is. If he doesn't believe how bad it is, he will not give you aggressive treatment. I'm not sure what that's about. If it feels like it's on fire, I think it's tendinitis and injections may fix it. So we shall see. I'm very much looking forward to it because it's right there, man. Oh, it's I wake up in the morning and it hurts. So thank you. What's that, Miss Carol? All right, so let's see what else we got here. We got all right, fine. Okay, so I'm just gonna. So if you all any insight about the new retirement savings plan going through Congress? Oh, okay, gotcha. Silicon Valley shoebox shout out, right on. Good luck. Yeah, I know, man. Oh God, it's painful. And the thing is, when you do something for the bulk of your life, and all of a sudden you can't do it, it's depressing. Really, I mean, I'm not depressed like Carol's saying. The new retirement things, I just don't find anything. Wow, I mean, it's just not a big deal. I mean, they're going to maybe push RMDs up till 72. Will they change the tables for them, or they make it instead of being 27.4 the first year? I mean, so here, let me see, like right there. Damn. So let me show you how it works. You got at 70, you got $100,000 in your account, and you turn. We're just going to say 70 for simplicity. So there's your IRA or 401k. You got 100,000. What they do is they divide that by 27.4. And so we know you're going to have about roughly 3,700. It's about 3,662. That's going to be your first RMD, about 3,700. And then it gets more each and every year, right? So you got 100,000 the first year, and then the next year you got to take it out by 26.5. So it goes 27.4. 26.5, 25.6, 24.7, and so on and so on. So that's your RMDs right there, 27.4, 26.5, 25.6, 24.7, and so on and so on. So the older you get, the larger your RMDs are. So it's great that Congress is thinking about pushing it back a couple of years. I mean, from 70 to 72. I mean, what to do? But the question is, will they still maintain the 27.4 in the first year, or are they going to push that back to make it a lower? Was it derivative? No, not derivative. The denominator. So you got the numerator, denominator, right? Yeah. So they make it so that now the denominator is, instead of 27.4, 20. I mean, they're going to change the tables, I would imagine. If they do, that doesn't solve anything other than give you a couple more years where you can CB from CA in the house, other than give you a couple more years where you don't have to take RMDs. But at some point, see, this is the thing, guys. When you have required distributions in IRA, you're paying tax on it. Somebody at some point is going to pay tax. That's all there is to it. And so that's all I really saw. Who asked that question? Rick, about the new tax thing. It didn't seem like that big of a deal, frankly. They're saying, I read the clickbait was one of the most, I don't know, biggest changes to tax law we've seen or something like that. I said, no, not a big deal. I think there's a couple other things in there that you could band together to offer 401k plans with employers. Well, hell, why don't they allow that with health insurance? That's my thing that ticks me off. And so right now with health insurance, I think Trump did get that through, if memory serves. I think he did with a tax bill. They got the thing where you can band together to offer health insurance through smaller employers. That's a big deal. I mean, look, if they want to do that 401ks, that's fantastic. I got no problem with that. But most people's pressing concern isn't the need to save a couple bucks in taxes because you're making $50,000 a year and you want to put $5,000 a year in a 401k. It's just not a huge tax benefit. It's not. But hell, the freaking health insurance is. And so I'm sitting there thinking, why can't they pull their head out of the butts and start allowing this stuff for health insurance? It's nuts. And so it should be over state lines. It should be, you can band together in these small communities to offer health insurance. So you got, I don't know, a plumber group in Mississippi should be able to join a plumber group in Louisiana. And now you got a one group orientation that can say, hey, we're going to offer health insurance benefits through this group. You got a whole bunch more buyers in there. And it's nuts. It ticks me off. So it's great. I mean, look, if they want to expand, it's fine. The concern I've got, though, is just the RMD schedule. I mean, that's not changing. They want their money and they're going to get it. So I just, look, I don't have any confidence whatsoever what's coming out of Congress for that. So that's not the Senate. That's the House of Representatives. I don't have any confidence whatsoever. If you retire at the age of 65, here, Lauren's going to have my show looked at the VA. Yeah, all right, man, that's right there. Good luck to you, my friend. All right, so question. If you retire at 65 with a full retirement age of 67, can you continue to donate to your Roth until you decide to pull money out of it? As long as you have earned income, absolutely, S. Chandler. If you got earned income, as long as you just lost it, all right, but we're back on. Shouldn't recover there, so hopefully that doesn't affect my Wi-Fi. So hopefully y'all can still hear me. Yeah, but absolutely. As long as you got earned income, S. Chandler. Chandler used to be the tight end for the Buffalo Bills. Then you can absolutely contribute to a Roth IRA without question. You just have to have earned income. And just by the way, remember, if let's say you work and Mrs. Chandler doesn't work, right? You can still contribute for her too, as long as you have enough earned income to cover both of you guys. So let's just say it's $7,000 a year you can put into a Roth IRA, and all you make is $14,000. That $14,000 can go to $7,000 for you and $7,000 for her. And I forgot what in 2019, I forgot what the numbers are on Roth. I think it's $7,000. You can make spousal contributions to a Roth as long as you have enough earned income to cover the amount. So if you only have $10,000 of earned income, you can't contribute $7,000 to each. You could contribute $5,000 to one, $7,000 or $5,000 to both, $7,000 to one, and $3,000 to the other. But just remember that Rex, right on, man. Hey, I saw we talked about Tim Pool the other day, a couple of weeks ago, and Tim Pool does YouTube videos. I just saw a video on him talk about nuclear power. I was stunned, man, because Tim Pool's a big lefty, and I was surprised to hear my man Tim Pool talk about nuclear power. So I'd like to see that. So just remember that if you have Roth IRA and earned income, you can contribute to your spouse as well. A lot of people don't know that, and they miss that opportunity. They would not. CB says, I thought my rotator cuff was shot, but it turned out to be an impingement. That's what I'm hoping it is too, man. Absolutely. Jack, hey, Josh, shout out from Columbus, Ohio. Right on. Can you explain, did the Blue Jackets make the playoffs, Jack? I think they did. Can you explain what sets income annuities apart from fixed and variable annuity? Yes, absolutely. Let me just double check my NHL app. So let's see here. Bear with me just a second, Jack. I will tell. Hey, TMK. Hold on just a second, my friends. The most important. I know the Bruins are playing the Maple Leafs in round 1, which is scary. Yeah, it looks like the Blue Jackets made, and they're playing against Tampa. Scary. You are keeping me sane in this LA Monday traffic. Sergio, you sitting there in traffic? Man. That's dedication, my friend. Right on. Okay. Can I explain what sets income annuities apart from fixed and variable annuities? Yeah. So you got 3 types of annuities, as Jack said, and I appreciate the T-shirt designs. I'm open to suggestions too, by chance. So you got the old school annuity is an income annuity, and that's called a tontine from the old days. And I was going back to Moshe's Milesky, a Hebrew speaker, told me the right pronouncing of M-O-S-H-E is Moshe. So Moshe Milesky out of the University of Toronto, a tontine. So that's the old school annuity from, we're talking a long time ago. It's as simple as can be. I give an insurance company $100,000. They're going to pay me $5,500 a year until I'm dead, or if I have a surviving spouse, she's dead. One of those 2 things. It's literally that simple. So now there's a bunch of different variations of that. And just if I may just sidetrack for a second, I talked to a guy today, Washington State. I'm just telling you, man, if you are married and you don't take a joint survivor life annuity, I don't know why you would not do that. I'm telling every single one I've seen hundreds and hundreds of them. The difference between a joint and life survivor annuity and just annuity on my own age is like $10 a month, if even that. So what that means is if I cover for me in Charlotte, so if I'm alive, I still get paid. If she's alive, she still gets paid. Does that make sense? So as long as one of us are absolutely breathing, we still get paid. So if I'm covering for she and I, it'll pay $1,000 a month. If I just cover for my own life, it'll pay $990 or $1,010 a month. If that makes sense. I mean, it doesn't make sense to get an extra $10 a month and not to have my surviving spouse covered. So always get the joint and life survivor annuity. I mean, I'm just going to, and I'll get more to your question, Jack, in a second. Joint and life survivor annuity. And I want to talk about annuities a little bit more too. JLSA 20. All right. So what this means, no one you ever going to see this. JLSA, joint and life survivor annuity with a 20-year period certain. Every annuity is going to allow that. You always want to get that. And the reason is, I mean, look, I've crunched these numbers every single way to Sunday. They might change in the future, but the time I've been doing this was a long time. It's always been the most advantageous for at least you're getting your money back. Because what happens is if you die before 20 years are over, your spouse will carry on. If she dies before 20 years are over, at least your heirs will get what you put in. And we know that plus some interest. They're going to get something. So for a fact there will be a return of principal plus interest on top of that. Now, if it's joint life survivor annuity, the likelihood of both you and your spouse dying within 20 years are pretty minimal. So that annuity will spread out for a long, long time. Hey, Pat, first time on. Marie's on board. Right on. Talat Zawede. Right on. Welcome aboard, Nancy. Okay, we'll talk about that here in just a second, Nancy. Okay. So anyway, always get the joint and life survivor annuity. I'm telling you, it doesn't make sense to do it on an individual life, and it doesn't make sense to do it for a 10-year period certain. Joint and life survivor annuity, 20-year period certain. That just is the most advantageous. All right. So going back to Jack's question. Variable annuities allow you to invest in the markets. So you do ETFs or mutual funds. So you have access to the equity markets, the bond markets, but you have access to financial markets through a variable annuity. And so because of that, the theory is your variable annuity could potentially give you more growth than what you could get income annuity, simply because you're saying I'm essentially deferring taking the income stream into a later date. And let me show you how this typically works. Look, I don't have any animosity towards variable annuities. I just don't think it's the most efficient way to do it. But you start with $100,000. All right, so you got $100,000. If you wait 10 years, they're going to say you have $200,000 All right, so they're going to say you're going to double your money, but this is not walk away money. I cannot stress this enough. How many people think that's a 7.2% rate of return on their money? It's not. It's a 7.2% rate on return on the income stream. And so what happens is, here's what I'm telling you what's going to happen. You're going to put $100,000 into a variable annuity, and they're going to say, we're going to double the amount for you to withdraw a certain amount in the future. So we're going to say we're going to $100,000. Fast forward 10 years, you'll have $200,000 of which you can draw 5.5% off. That's what they're going to say. I cannot stress to you how many people thought that was walk away money. What I mean walk away money, how much of a check can I get? It's not $200,000. It's not. We don't know what it's going to be. It'll probably be around $140,000 or something like that because of fees, but will not be $200,000. This is the amount of money you take on an income stream at 5.5%. It might be 5%. It might be 6%, depending how old you are. But that's what they're going to say. They're going to say, give us the $100,000 and we will guarantee you're going to get $11,000 a year of income. Does that make sense? So $100,000 will guarantee $11,000 of income that you can't outlive. It's not a bad deal. They're not bad deals. The problem is what these guys say is, I'm going to get $11,000 of income on a $100,000 investment. And what these freaking guys will tell you is that that is a 11,000 divided by 100, an 11% distribution rate. Because they're going to say, well, Mr. Smith, you're only putting in $100,000. We're going to guarantee you $11,000 of income. That's the equivalent of an 11% payout rate. It's freaking bull crap, man. It's completely, it's fraudulent. It's lies, and they shouldn't do that. Most guys don't. Most guys in the business are actually okay. I'm telling you right now, I've been around a long time. I haven't seen that many corrupt fools. And most of the corrupt fools are people trading because they think they can beat the market. There are some corrupt insurance guys, don't get me wrong. Most guys have been around. They're not stupid. They just don't know. They're ignorant about their own products. I've seen that a million times a Sunday. But if you hear somebody saying, I'll give you an 11% payout rate, run for the freaking hills. There's nothing that does it. There's nothing that does that under the sun. Now, what happens, though? So we got $100,000. Oops. All right, we got $100,000, and we have a $200,000 guaranteed income stream for which we can draw that 5.5% a year off. Usually, like I said, 70 years old or something like that. So we start at 60 years old, $100,000. We're 70 years old. Now we're guaranteed 5.5% on that $200,000. Now, what happens is they'll say there's a chance that income stream could go up too if the markets cooperate. And see, the problem with that, and that's true, it could. You could actually end up making more money on that variable annuity than you could on a fixed. Well, we'll get to fixed annuities here in just a second. Than any other type of investment account, simply because if the markets cooperate, you could receive more than $200,000. It might be worth, you put $100,000 in there, and the markets go gangbusters. Now it's worth $240,000. So now you're getting 5.5% on that $240,000 because after 10 years, you actually did better than what the insurance company guaranteed. But the problem is that's never going to happen because the fees are so flipping high. I mean, you're paying 3 to 4% fees. And there's no way with that kind of fees, you're going to just dwarf what they're offering. It's just not going to happen. So a lot of people get caught up like, I might actually make more than what the insurance company is paying me. Yeah, I mean, you could. Imagine if you rolled the dice, 50 times, 10 times they're going to come up double sixes, whatever, but it's just not likely to happen. So variable annuities for an income stream, I just don't like them because I think the alternative is better, which is an immediate annuity. You say, okay, I'm going to take an immediate annuity. I know for a fact I put $100,000 in today. I will start today getting $5,500 a year. And I know that, and I'm done. You don't have to worry about it. Now, what do I do with my remaining money is I can invest it in a naked account, i.e. not tied down with the clothing and the cover of variable annuity fees. So I'm saying now I'm going to put my $100,000 in this fixed annuity, income annuity, generate the income I need. And then my other $100,000 I'm going to leave in there. And what that's going to do now is that's going to grow because it's not tied down by this 3% fees. I should be able to make a lot more money in the long run. No guarantee. I mean, there's more risk inherently, but for a fact, worst case scenarios, that $100,000 is locked in at $5,500 a year for the rest of your life. A lot going on there. I'll do another video where I get the whiteboard. I'll show it a little bit better. But that's a variable annuity versus an income annuity or immediate annuity. Fixed annuities are simple. I mean, literally the simplest thing in the world. You put $100,000 in. The insurance company says we'll give you 3% a year for 5 years. You'll come back 5 years from now and you got whatever that is. I don't know what it is off the top of my head. $125,000, something like that. That's it. No risk, no muss, no fuss. I love fixed annuities. If the rates are preferable to CDs, and I don't think they are right now, because CDs are FDIC insured, and CD rates are probably right there with fixed annuities. Now, CDs are taxable as ordinary income. Fixed annuities are deferred. But anytime you take money out of a fixed annuity, you're still paying income tax, ordinary income tax. So you're deferring the tax to a later date. It's not necessarily a good thing. So of the two there, I like CDs better than fixed annuities, 75% of the time, 80% of the time. Of the two, income annuities versus variable annuities, I like immediate annuities. Income annuities is synonymous about 85% of the time as well. All right, I hope that helps, Jack. Good question. Again, I'll do more videos on that for sure. Yes, so Steve says, can I contribute to my 401k Roth in a separate IRA? Absolutely. Yes, sir. You have limits on how much you can do to both, but without question. S. Chandler, thanks for the clarification. Yes, sir. A local planner told me, Nancy says, where do we see it, Nancy? A local planner told me I couldn't contribute to a conventional IRA. Dick is still working. I don't know why. I mean, if you're making money, you can. I don't get it. I don't know why you're saying that. Nancy, I forgot how old you are, Frankie. I don't think you're over 7.5, so that doesn't make any sense to me. So I don't get that. That's wrong. First time on the live chat, says my man Pat Schuster, or my woman Pat Schuster. Thanks for all your help understanding all this stuff. Barry, you mentioned Obama subsidies the other day. Do you know if they count as income on your tax? Man, that's a great question. I don't know, Barry. It's a great question. Great question. Let's see here. Will Bitcoin crash with a war? Man, I have no idea. Bruce on the line. I don't know about Bitcoin. I just don't follow that much. Pistol Pete, right on. Pistol Pete Maravich. Best retirement planning channel on YouTube. Tell your neighbors. One trip to the hospital wipe it out. I'm not sure. Yeah, I don't know what that is. Marie says, thanks for the video on a single gal retiring. You answered the question on whether to convert 401k. And I decided not to do it. So for all of you who didn't watch, I did a video last night on Deb, 59-year-old single lady, not a huge, she had, I think, $500,000 in her retirement accounts, not a huge expenditures. She didn't have much she needed for expenditures for sure, which was nice. But the question that I could not, and I tried, is it didn't make sense to do any Roth conversions for her. It didn't. And you know how much I love Roth conversions. I just couldn't make it work. And then someone, I forgot, on the YouTube channel, the comment said, don't forget about the Obamacare subsidies as well. And I forgot about that. See, that's a new thing for financial planners. I mean, the Obamacare subsidies is a relatively new thing that we got to get our minds wrapped around. Because I mean, it's literally from out of left field that came. So I never really much thought about that. But for her, because she was 60, going to retire, and then she wasn't going to have any health care. And we anticipate $500 a month on healthcare from now until basically until she dies. That might not be the case actually with Obamacare subsidies. And I can't remember off the top of my head what her income was, but it wasn't much. I don't know if she's going to qualify. But that was an interesting point. Someone commented on that. I forgot who it was, or else I'd give you credit. But good job there. But anyway, so we just kind of came to the conclusion that didn't see worth it to do any Roth conversions just because it should be front loaded in taxes, under the assumption that it'd pay off big dividends, and not even, it wasn't big dividends either, but under the assumption pay off for her in the long run. And we just, in that case, it wasn't enough savings in the long run to make it worthwhile to take that risk, if that makes sense. And that's not true for everybody. But in this case, for old Deb, it was for sure. So yeah, good. I appreciate that, Murray. My man says, Bruce, we were talking about Bruce in the house. Vanguard managed pay or income annuity. I've looked at the managed pay, Richard, a couple of times, payout fund. So Vanguard's got a managed payout fund. I just had a hard time tracking it, to be perfectly honest. It's not that old. And I just think income annuities are simple, right? It's just, you know exactly what you're getting without question. this could be, and one of these days I'll do the video on it, but Nationwide did a pretty good article, actually. This is, I don't know, I'm sorry about my t-shirt here. I just put my kids to bed so you can see I'm professional, man. This is sophisticated stuff here. You come here for sophistication. I should get old Herbert to bring me a glass of sherry. I don't even know what sophisticated drink. Well, I don't know. Anyway, what was I saying? What were we saying, Richard? Oh, the income annuity. Oh, yeah. So Nationwide, they did a wonderful study a few years back where they compared using an income annuity versus not an income annuity and seeing what not only the income generated was, but also the balance that you're accumulating as well in terms of leaving to your heirs. And it was pretty good. Now, Nationwide is an insurance company, so they'd love for you to buy annuities from them. So you always got to take that with a grain of salt. But I thought that was a pretty good article, in fact. If memory serves, they might have done it on a guaranteed minimum income benefit from a variable annuity as well at 7%. I think the income annuity was better. I got to double check. It's been 3 or 4 years since I read that article, but it was actually pretty good. I looked at it very favorably towards Nationwide because they really talked up income annuities over their own product, which is variable annuities. If I'm mistaken, in terms of Nationwide or who I'm almost positive Nationwide, but I'll look at that, Richard, and get to it. So the managed fund at Vanguard, I just don't know enough about it, man. I don't know. It doesn't have much of a track record. I couldn't find much info on it. It seemed like I read some information on it. I was like, it's okay. But it didn't make me say I'd do that instead of an income annuity. But remember, the drawback on an income annuity, my friends, is once you do it, it's irrevocable. You can't not do it. Once you do it, it's done. You don't get it back. Most insurance companies, by state law, will give you a 15-day free look period. So you can sit there and chomp on a little bit, and then you get your money back if you want without surrender charge or anything like that. Some insurance companies, depending on the state, will give you a 30-day free look period. But the ones we used to offer at USA, because people were hesitant because they're literally locking up their money for years. I mean, well, not literally, but, metaphorically locking up their money. They even had a clause where you could take an emergency payout of up to 50% of the cash for various emergencies. There's like 3 or 4, and not somewhat lenient, but not as lenient, not to go to a baseball game. And that was okay, but that if you were to do that, just blew the whole thing up. So that's the thing about income annuities. You got to be willing to part with your money for the rest of your life. I mean, that's all there is to it, to get an income stream. Someone asked on the YouTube channel last time, and I don't think, or maybe it was, I can't remember, but I don't think I ever responded. When he was thinking about doing an income annuity through his TIAA, I believe. Anyway, and I told him when I was at USA, you could not do more than 50% of your liquid net worth into an income annuity. USA would not let you do it, let you as me, as the financial advisor. And he said, why couldn't he do that with his own money at TIAA or whatever the company was? I said, if you want to do it, it's your freaking money. They'll let you do it. They're just going to document it like crazy that they warned you about the lack of liquidity and all that. So you can do that. It's just no financial institution is going to say you should do 100% of your liquid net worth into an income annuity simply because that could be bad news if you needed the cash later on. Should have qualified, off the top of my head, can't remember what the LAC stands for, be part of a retirement plan. I looked at those a little bit the other day, Dennis, and I wasn't that impressed, frankly. Qualified, I can't remember what the terminology stands for. It didn't do anything for me. I just said, it was all right, but I didn't see anything overly beneficial there. And that's the one you can defer taking your RMDs until you're 85, if memory serves. And it's because of that, again, kind of like this whole retirement plan thing, they're thinking about changing where they're going to increase the RMD age to 72 from 7.5. It's just, at some point, it's still got to be paid. And if I remember, the QLAC is that you can only put a certain amount of money in relative to what it's like 25% of your account balance or something like that. So you have $100,000, you can put 25% of QLAC. Now you only have RMDs on the $75,000 until you're 85 years old, and then you have RMDs on that plus a QLAC comes out. It didn't seem that big of a deal to me. Is a Roth IRA distribution considered in your MAGI for premium tax credit? When you say premium, if you talk about Obamacare, I don't think so. So they're not. So the modified adjusted gross income is absolutely Roth distributions are not considered when it comes to tax on your Social Security or your premium for Medicare. And I don't think that's what you're saying, Frank. If you're talking about Obamacare premium, I don't know, because I do know, shameless plug, in this book that this guy wrote, The Tax Bomb in Your Retirement Account, one of the things I talk about the Roth is they are, hold on just a second, I'm going to show you right here. They may impact financial aid. Roth distributions may impact financial aid. So there's 4 things I said the Roth don't do for you. One is they are included in your estate tax calculation. So if you live in a state with a state estate tax, Roth IRAs are included. 2, your spouse does not get a step-up basis, or non-spouse beneficiaries, should say. There's no step-up basis in Roth, and it doesn't really matter because it's all tax-free. Roths are subject to creditors, though. All right, so just keeping that for non-spouse beneficiaries, Roth IRAs are subject to creditors, as are regular IRAs too. But still, I had to point that out. And I said Roths do not get a step up in basis. And then finally, Roths are included potentially. They may be included in your financial aid disbursement. Just keep that in the back of your mind. So some of the drawbacks about Roth, and it's not even a drawback, I mean, also the traditional IRAs as well. But when it comes to Obamacare premium, I don't know. My presumption is probably not, Frank, but don't quote me on that. Maybe my man Ken, the CPA from Atlanta, is on board. If so, he could chime in there. My man Working Stiff is in Birmingham, New York, still working because he's a working stiff. Chumon County, New York here too. What was I just reading about New York? Just tax, like what was Cuomo was just singing the praises of some crazy freaking tax thing they're doing. I said, man, who can afford to live there anymore? It's nuts. All right, let's see. Tony from Waldorf, Maryland. All right, Waldorf, thank you, sir. Doug D, hi, Josh, and a profit sharing plan of my own. Okay, right on, man. Tony from Waldorf, we talk about Waldorf, Maryland. I went to high school in Silver Spring. Pay off my mortgage at 3.5% or put the money into a Roth. Clint, man, I just think pay off the mortgage, man. I'm telling you. That's my suggestion. I pay off that sucker. I don't know what it's like to be mortgage free, but I can only imagine the freedom you must feel to be mortgage free. And I talked about that in actually my other book, Strategic Money Planning. And you think about it, you got let's say you have $100,000 doing a mortgage, and then you were able to squirrel away $100,000 in your Roth. So you think you're even Steven. Well, then the markets take a tank 30%, and then you get laid off from your job. You still got this $100,000 mortgage. You only got $70,000 in your Roth anymore. So I'd pay off the mortgage. At the end of the day, too, we got to, what's our expectations for future growth? 6.5% to 7% is what we're looking at. I would suggest in a pretty aggressive portfolio. That's before inflation. So you're looking at, 4 to 5% roughly after inflation. Look, I won't scream and holler at you, Clint. You're 11 Bravo, so I don't have enough guts to do that. But at the end of the day, man, get that mortgage paid off. This is the way I see it. My brothers pitch a CD alternatives. All right, Jack. So CD alternatives, my goodness. When I was at Smith Barney, which was Legg Mason, then Smith Barney, then it's Morgan Stanley now. I don't even know what these guys have changed. But anyway, we used to have these CD, FDIC insured structured notes. CD alternative that gives you access to the equity markets with no downside risk, and they're FDIC insured. I mean, what the? I mean, I'd sit in there, and the whole point about it is to make money for the firms. It's not about to make money for you. And what happens? This is a wonderful sales pitch because it turns over every year. So the market goes up, you make a portion of the money. The market goes down, you may lose a little bit, but you won't lose much. And you still get FDIC insurance. I'm just, this is going on 15 years ago now, but just that's how these things work. You're like, oh, FDIC insured, so I can't lose money or whatever it is. I mean, just, at least with a CD, you know exactly what you're getting. You're getting 3.5% done. Put it in for 5 years, put it in for 2 years, done. With all this other stuff, I guarantee the guy who sells it to your brother doesn't know what the hell he's talking about. I guarantee. He's like, well, you do this. You're like, all right, does it include dividends? I guarantee, Jack, it's not going to include dividends. All these equity index stuff, index life insurance. What's the other one? structured products, CD alternatives, they all don't do dividends. And so right there, you got your hands tied behind your back because dividends account for 30 to 40% of the returns of the market. So now you're going in there just with one hand tied behind your back. And so it's like at the end of the day, now we're just relying on point-to-point price appreciation of the markets. Well, hell, any given year, the market goes down 40% of the time. So it's just, I still rather make 3.5% fixed than hope I might be able to make 4% without the dividends. It's just not going to happen. You're not making, with a low capital appreciation that we should be anticipating, which everyone is going forward, you're not making any money relative if you're not including dividends. So you might as well just be in the CD and be done with it. That's just my point. Now, what happens is they'll turn them over every year. Okay, Mrs. Smith, your CD just matured. Want to do another one? Yeah, and they get 3% front-end commission. I got no problem. I literally have no problem with commission as long as it's disclosed. How many times they disclose that stuff? None at all. Depends on where you are in your mortgage. I agree with that. Josh lets us not forget about the 10% bonus they used. Yeah, man, my man Sergio sitting in the traffic in California, IA. If they have to give you a bonus to get you to buy their product, why? Why do they have to do that? Does Warren Buffett, Berkshire Hathaway stock offer you a bonus to buy his product? No, you don't need to. In fact, Warren Buffett says explicitly, don't buy my product, buy the S&P 500 index. And on top of that, Warren Buffett says, I'll never pay a dividend. I'll never pay a dividend. He said one time, it's like in 1967, they paid like a 2-cent dividend. And he said he must have been in the bathroom when the board of directors approved that. He said, I don't believe in dividends. I'll never pay a dividend. Don't buy my stock, buy the S&P 500 for diversification. There certainly isn't a 10% bonus. That whole 10% bonus stuff, like we're going to make you, but the whole point is they're trying to get you to, if you look at the history of variable annuity accounts, they're sold from annuity to annuity. They're not sold from new money coming in. It's annuity to annuity. So basically what's happening is they're closing out annuity A over there to put you in annuity B over here. So you sat there for 7 years in that, paid that surrender charge, that sales charge, got your 5% bonus, whatever it is. Now they're going to do what's called a 1035 exchange from that annuity to this annuity. And the guy who sold that one to you is probably gone because he probably failed out of the business. But now this guy is going to say, oh, we got new annuities. They're even better than what you bought before. And you keep doing this. You keep doing this. You keep doing this. And you're paying more and more and more. You can't make any money. And so what finally happens is that's how they're, I mean, I think is like a sick amount of money. If they looked at the variable annuity sales, it was all coming from what's called exchanges, from one annuity to the other. It was very, very little new money coming in. And so they're basically churning the poor souls who don't know any better who are buying these variable annuities. I sold variable annuities. I'm telling you, I don't think they're that bad. I don't. The sales practices drive me crazy. The 10% bonuses, the point-to-point with no dividends in there, and the hell, the freaking expenses in there. And don't even get me started on the death benefit. I've done videos on it. I got to share it with you. All right. So the variable annuity, you get 1.3%. It's called an M&E. It's called the mortality and expense. It's usually 1.35. It might be a little bit less now because the annuity companies know they can't get away with it. But still, it's a significant amount of money. Right. So what that covers is essentially death benefits. So let's say you put $100,000 in there and it drops to $80,000. All right. So you put $100,000 in there, it drops to $80,000. You die. Your heirs get $100,000. That's what happened. That's what the M&E expense costs. All right. So the difference between $100,000 and $80,000 is $20,000. So you've been paying essentially for $20,000 of life insurance. So that way your heirs can be made whole on the amount you put in. Does that make sense? $100,000 what you put in, the market fell 20%. You die because you had a heart attack. Your down account's worth $80,000, but your heirs get that because that's what you put in. Now that costs you for that $20,000 of life insurance, that 1.35%, because a mortality and expense ratio is on the cash value of the account. It costs 1.35%. So that would be roughly, I don't know, between $80,000. Oh, so hold on just a second. $80,000 times 1.35. That's over $1,000. That's between $1,000 and $1,300 a year in insurance that you're paying for that $20,000 death benefit. Does that make sense? I hope that makes sense. It's incredibly, incredibly important to understand. Now, watch what happens though. Let's say I put $100,000 in there. All All right. And the account goes to $200,000. So now I'm up by this amount. Now, if I just did the basic death benefit, which most people do, I don't do the step up, I am paying 1.35% on this. But for what? There is no death insurance. There's no death benefit because my cash value is this. So if I die, my spouse or my heirs get this. They don't get this amount. They get this. But I'm still paying that 1.35 on this amount, even though there's literally there's nothing there. It's literally empty. It doesn't pay anything because I have more cash value than what the death benefit is for. So I'm still paying in that case, what's that, $2,000-3,000 in fees for literally nothing. And that's just the basics. Now, what they'll say is, we'll give you a step up. We'll give you for another 25 or 55 basis points. So now we're talking 1.6, 1.7%. We'll step up that death benefit. So if you have $100,000 and it grew to $200,000, all right, so now you got $100,000 in there. It grows to $200,000. Now let's just say it slides back to $170,000. All right, I know this is really chicken scratch. All right, so I had $100,000. My maximum account value is $200,000. So now I paid a fee, an extra fee to get an enhanced death benefit. It's usually what's called an enhanced death benefit or a step-up death benefit. And now I die. So now my account's worth $170 because the market fell 15%. My heirs get the $200,000. All right. So again, the difference between $200,000 and $170 is $30,000. How much was I paying for that life insurance? I was paying, 1.5 to 1.85 on $200,000 for essentially a $30,000 or $40,000 life insurance policy. Screw that, man. Just go buy a term. You don't need all that crap. Anyway, it drives you up the wall, and no one gets that. And certainly the agents who sell that stuff don't understand. I'm telling you, just don't. They're going to offer, well, we're going to give you $5. Don't even get me started. All right. 27 years ago on the mortgage, I plan to retire in 7. Yeah, Clint, that means you're still paying significant interest. I'd pay that sucker off. Yep. I would be done with it. Seriously, your no-nonsense approach and subject discussions are invaluable and beyond any financial planning I've talked to. How can we best help you make money doing this? I don't want to share the spreadsheet, Pistol Pete. I just don't want to do that. Just hit the like button. That's how you can help. Share the videos for sure. Absolutely. But I'm much obliged for sure. My man Renan is a big Minecraft guy. Is that my son? Because my son Kevin is on Minecraft a lot. Renan, and I'm just going to get rid of you. Intra X videos. Don't know what that means. Let's get rid of this guy. So my man, this guy is very big on Minecraft, and my son is a Minecraft addict as well. So, all right, let's move those guys. Man, get a lot of Minecraft people here. Oh boy. So I guess I have been founded by Minecraft people. Man, I have 200K. Jeez Louise. Let's see. Let's mute some of these people. All right, hold on just a second. There's got to be a way to do this in the future so I don't get these. I must be getting some traction because I'm starting to get some more trolls on here. So I must be getting some traction on my my YouTube channel, which is good. All right, so let's get rid of STK. I wish I could give a moderator something to do this so they can just get rid of these fools. Jeez Louise. Just go create your own channel, man. Good night. All right, all right, so let's get these guys. All right, so we had okay, here we go. Phil, I have 200K at Vanguard and a Target 2025 fund, 250 at TIAA-CREF. Thoughts to transfer from TIAA to Vanguard. All right, so be careful because the TIAA, man, is at least they used to. That annuity they offer is like 4.5% minimum guaranteed. You can't beat that. I'm a huge fan of that TIAA-CREF minimum 4.5 guaranteed. So just be careful. I mean, now the thing with TIAA, a couple of things going on is that some of them, they have very explicit limitations when you have access to your money. I think you got to take it out within a 10-year time frame or something like that, Phil. So just be careful on that because, A, you might be leaving behind a pretty good product, first and foremost. B, you might not be able to roll the whole thing over. I mean, I've seen that happen a million times. That TIAA says on their annuity part of it, I forgot what it's called. I forgot that you can't roll it out. You got to take it as income distributions over a 10-year time frame. If that's the case, there's nothing you can do. It's contractually obligated for you to do that. So be careful. My preference is Vanguard over TIAA, other than that annuity that they offer, because I don't like TIAA, generally speaking. I think they're virtue signalers, if you know what I'm saying. I mean, I've known tons of people who've worked at TIAA, and I can tell you the stories about their sales stuff. It's just not good. It's bad. Their number one concern wasn't they're not for the greater good. They're the greater good of their own pocket, according to the people I talked to. And these people are legion. TIAA-CREF was, they're in the New York Times not that long ago for misleading their clients. Just bad sales practices, no other way around that. And I kind of chuckle because the same thing, I actually emailed a bunch of friends at USA saying, wait, USA is going to be the same category here pretty soon if you're not careful, because USA is doing the same thing. In fact, the irony of it all is the USA wealth management model was based hook, line, and sinker off of TIAAs. They hired some freaking clown to come over from TIAA and bring that model to USA. And this guy was an idiot everyone knew he was. He's an idiot from day one. And yet he brought this model from TIAA. I don't know who he hoodwinked. I don't know if he had some kind of, text from the bosses or something. I don't know what kind of stuff he had on these people, but everyone's like, this isn't, what's going on? I mean, anyways, long story short. So TIAA, Vanguard, look, you're not going to get a sales pitch from Vanguard. I like that. And the Vanguard owns the members, or I should say the investors own the firm. So TIAA is different. Theoretically, it's not publicly traded. They're supposed to be for the greater good. I just don't buy that. And secondly, I'll tell you too, I had a survivor life insurance policy with TIAA, and trying to get that sucker done was like pulling teeth. I mean, not only, man, it was nuts. And trying to get a life insurance policy then it was horrific. I said, dude, I want to buy this product from you guys, and you guys are making this like I don't matter. And it was bad. So my experience with TIAA-CREF is poor, to say the best, to say the least. So that's in my opinion. People could disagree. I'm fine with that. Where can we find your book? By the way, I'm a guy, Patrick, right on, Patrick. Just go to Amazon, type in my name, Josh Scanlon. I got 3 books out there now. This third one is state-by-state tax, is more of an ebook than anything. State-by-state tax guide is what it was, 2018. I don't think much has changed for 2019, but it's pretty interesting because I did a state-by-state analysis of property tax, sales tax, and income tax on each of those states, every 50 states. And, it might be a little bit changed, but it was interesting. And I did videos on each of these ones too. That was the genesis for me to do the book. What I liked about it, and this is what I tell people all the time, like I got some folks from Tennessee on here, and I got some people trying to convince me to move to Tennessee because there's no state income tax. Yeah, there's no state income tax, but sales tax is through the roof. Georgia has a state income tax, but once you're in Georgia, and once you're over 65 years old, you don't pay tax on the first $65,000 of income that you have per person. So my wife and I, essentially, when we're 65, there is no state income tax here in the great state of Georgia. And yet we still have much lower sales tax. Property taxes are going to be higher here in Fulton County. But if you start going up, toward Blairsville and whatnot, and in Lumpkin County, property tax aren't going to be that much higher than Tennessee. So you just gotta be careful. Don't fall hook, line, and sinker for the no state sales tax things. There's more to the story than just that. I'm just telling you. And so that was what made it interesting to do that book. Kentucky. Now they just did pass a law 6 months or so ago, which eliminated some of those. Kentucky was significantly beneficial when it comes to retirees. Significantly. I mean, huge, even though they have a state income tax. They reduced that to some degree. I think you had 40,000 of income first. You didn't have any tax on the first 40,000. Now I think it's 30,000. But Kentucky was favorable. So for folks who are thinking you're in Tennessee, you're looking at Kentucky, Tennessee, or Georgia, you're saying, okay, Kentucky, Tennessee, Georgia, or Florida. You're like, well, Florida and Tennessee have no state income tax. So I'm going to look at those 2 states. I'm going to overlook Kentucky or Georgia. You're making a mistake. You're making a big mistake. Both those states are very, very favorable when it comes to retiree tax planning. Now, I will say Kentucky is in a world of hurt because they got a lot of pensions they're not funded. It's kind of like Illinois and New Jersey. Kentucky is probably the only southern state out there that with pension liabilities it's going to hurt them. There's no other way around that. That's going to have to be addressed, just like Illinois and New Jersey. And there seemed like one other state I'm thinking about. I can't remember. But couple other things too. Maryland and Rhode Island are much more. I got a guy I was talking to who's saying I got to get out of Maryland, and I think he was born and raised in there. His wife's from there. I mean, they lived on the Eastern Shore. It's a beautiful place. I said, why? They say taxes are going to eat us alive, and we do the financial plan. I said, no, it's not. You're fine. The issue is even in California, once you're below a certain threshold of income, and that's pretty high income, like $60,000, there just isn't that much state income tax to be concerned. There's just not. The property tax, this is why I say the property tax. If you're going into retirement, look at the states with the biggest property tax and avoid those with the plague. If you're going to own something, even if you rent something, you're still paying the property tax. You're paying it through the rent. So look at the states with the highest freaking property tax. Texas, I love Texas, but the property taxes are through the roof. You still get homestead exemptions, I get it, but not enough to justify how high the property taxes are. There's no state income tax, I get it, but they have a property tax that's pretty significantly high. Look, I would not rather live in Hawaii because I do like firearms, but Hawaii has a much, much more favorable property tax than Texas, even though Hawaii has an income tax. But when you put the two together, now look, I'm not talking about groceries or anything like that, but when it comes to pure taxes, Hawaii is actually favorable to retirees close to Texas, but no one to think about it like that because they're saying the cost of living in there is so high. Look, I don't disagree with that. But when it comes to property taxes versus Hawaii and income taxes in Hawaii versus property taxes in Texas and income taxes in Texas, Hawaii is not that far behind. It's just not. So you got to look at more than just the income tax, if that makes sense. Seems like something else I want to say on that. Now, I didn't look at things, but you also got to look at things like Medicare, your Part C, which is Medicare Advantage, or your Medicare subs. All right. So like I did a video the other day on California. My aunt was in town and she has the Blue Shield 65 plus HMO. It's a Medicare Advantage plan. Now, it's an HMO, but she's in Los Angeles County. All right. I think Los Angeles County is pretty populated. So I did it on my video. I showed you, I looked up docs in her area, hundreds of them. And so the issue with Medicare Advantage over Medigap is that Medicare Advantage is an in-network. You have to be in-network to get the major benefits of it. Well, if you live in a populous county like Los Angeles County, the likelihood of you having a pretty lenient network is pretty high. On the other hand, if you live in a rural county, Lumpkin County, Georgia, I've used that for example, is probably going to be few and far between providers. So you might want a Medicare supplemental policy, which is going to be more expensive than a Medicare Advantage policy, if that makes sense. So you just got to look at that too, because I think my man J.O., when I was interviewing him, I think he said New York State, the Medicare Advantage plan is like $220 a month. Another reason to get the hell out of there, man. I'm telling you. If you got Medicare Advantage at $220 a month plus your Part B plus your Part D, man, that's just nuts. That's expensive. So his option be mortgage free, says my man Doug D. Yep. Could not agree more. I have no clue what it's like. Nancy says, what is the better place to park cash, prime money market or spider? I would do the money market. I'll do the money market, Dick, for sure. Book found at his website or Amazon. Yeah, it's going to Amazon. Yeah, in New York, says my man in Bennington Whalers. In New York for the pension, then he's out. Yes, sir. Thanks for all your videos. I love them, says Rhonda Bible. You got it. Thanks. Yeah, you got it. Frank, I found this on the web in regard to the premium tax credit. Yeah, there you go. So Frank says, qualified withdrawals. Remember, qualified withdrawals, you got to have it open for 5 years and be over the age of 59 and a half. Both have to open for 5 years and be over the age of 59 and a half for qualified withdrawals. Are not considered income when it comes to premium tax. That's fantastic. Good job there, Frank. Let's see here. Which option is better for retirement? Oops. Yeah, I'm trying to ignore them, Richard. Just kids. Why are kids on this video? Which option is better retirement? $50K for a year or 140K plus 100,000 cash? Joe Qualer, excuse me. Which 50K? Yeah, man, I need to know more than that, my friend. I guess at the end of the day, you could say if you lived 15 years you'd probably want the 50K over the 40K because you'd have made 150,000 more, if that makes sense. Generally speaking, I'd rather have the 50K just because, like I said, if you live a few more years than 10, it's going to pay off for you in droves for sure. Now, but I mean, you could theoretically say, okay, I'm going to invest 100K and I could double it till I mean, the endless debate, cash or the hope for the market returns. I do want to point out real quick, and I was reading this right here. I'm going to do a video on this. Actually, this is my man. You know, I talk about Med Favor a lot. This is the Trinity portfolio. I'm going to do a video on this tomorrow, I'm thinking, from Cambria. And Meb, just this is what, I don't know, 30 page or something like that. But he talks about that we always focus on the returns of the stock and bond market of the U.S. over the last 100 years, as if that gives us any guide to what the future could hold. And he says, but what happened to Russia? What happened to, what is the other ones he used? Greece and just all these other countries. At some point, Venezuela was very prosperous. You know, I mean, I thought it's very interesting what he said, because we don't know if we were the lucky ones. Now, look, we're somewhat capitalistic still, so I'm pretty comfortable that we'll be better than most other countries, but you know, we don't know. And so what if we're wrong? What if we think the model of U.S., you know, stock and bond is the way we should assume? So going back to your thing, Joe, I'm going to take my cash and invest it because, you know, I think I can do better than a guarantee from the government or the insurance company. I guess it would be the government because it's a teacher pension. What if you're wrong? And that's the issue. Look, that doesn't mean to put everything under your mattress, but going back to what Clint Collins said about paying off the mortgage, I mean, what if we're wrong? What if the other options don't pan out like we had thought over the last 100 to 120 years? And I mean, if you can't be wrong if your mortgage is paid. I mean, they could raise property taxes. They theoretically could come confiscate your property, but that's not as likely to happen as the market's not doing as well as you anticipate for sure. Cincinnati, right on. Cincinnati in the house. My aunt is a big Cincinnati Reds fan. Tim, are you familiar with the Allianz? All right. Anytime I see Allianz Jack, I run for the hills, because when I came up in the beginning of my career, they used to argue all the time about big commissions. We go to these conferences, say, look, we pay the biggest commissions. And we're looking around saying, okay, I guess I'll go out there and sell that to it because they pay the biggest commission. So I've always been a skeptic of Allianz, and they always have the nicest bells and whistles and the nicest marketing pieces, and that someone's paying for that. It's going to be you. So look, if a guy works for Allianz here, prove me differently, but I'm just telling you, my experience was if they're leading their sales forces by the higher commissions they pay than the other firms, that means their products are inferior because they have to offer the higher commission. So that's just my opinion. Jack, I don't know anything about the fixed indexed annuity. I'm generally not a fan of FIAs, again, because they don't allow you to roll the dividends over. You don't get the dividend credit. And because you don't get the dividend credit, you're going in with one hand behind your back without question. After investing in a Roth and S&P ETF, where to next for building a wealth base? Okay, so if Bruce, if all you got is the S&P, I mean, I'd still think small caps. So maybe like the extended market index, that's where I'd go. If that's what you got is the S&P 500, you don't have any small cap exposure. And I still believe small caps have a upside more so than large caps. Is one of the factors that French FAMA talk about. It used to be a 3-factor portfolio: a small cap value, price to earnings, and price to book, if memory serves. There's 3 factors. I think they've now changed it to 4 factors. I can't remember what the 4 are. I am a believer small caps have more upside over a longer term than large caps. Simply because Amazon started as a small cap. I mean, that's all there is to it. I mean, Microsoft started as a small cap. They didn't start on the S&P 500. So I just think I'd go small caps, get some more small caps to close out your total stock index. Barry says, my wife works for a quasi-state government company where they don't take out Social Security, but they have a 403B pension. Yeah. Did I mention? All right. So yeah. Did I mention she won't be eligible for spousal benefits? I don't see how she's going to be. Because what happens, you have this, she's not put into the Social Security system. So what's going to happen is she's certainly, I mean, could she be eligible for survivor benefits? I don't think so. Survivor benefits have what's called a government pension offset. Barry, the government pension offset will probably eat alive any of the benefits you would get. So the GPO is probably going to wipe her out from survivor benefits. Spousal benefits called the windfall elimination provision, the WEP. Will she be eligible? Maybe, but it's going to be tough to see how much it'll be, if anything, simply because that, I want to say the max is $484 a month. We'll just say $500 for sure. So let's just say you have a spousal Social Security benefit of $2,000 a month. It's going to be half that as a spousal benefit anyway, is $1,000 a month. You're taking the WEP, she'll get $600 a month at most in that scenario right there. My presumption is probably it's not going to be much. Not going to be much. And certainly the survivor benefit probably won't be anything, I want to think. You may be born again, John. Yeah. Is there somewhere I can read about this? Says Barry. Yeah, I would actually start on Devin Carroll's stuff. His whole YouTube channel, my understanding, and I don't know if he, in Texas, the TRS, the Texas retirement system, a lot of those counties did not pay into the Social Security system either, just like what happened with your wife. So the teachers were getting a Social Security. My inclination, I imagine Devin had a lot of clients come to his neck of the woods through Texarkana, who were surprised that they weren't going to get anything for Social Security. I'm sure he had to, get educated on that, and he did. And so I would absolutely go to Devin's channel, because he'll talk about that without question. You look at GPO. In fact, I had a printout from him I saved on GPO, government pension offset, that he did, that I was going to share with you guys because I thought it was awesome. Just type GPO, government pension offset, and then WEP, the windfall elimination provision. His is going to be the best, in my opinion. Of all the stuff that's out there, his 2 videos on that were incredibly helpful for sure. Yeah, I know Texas has no state income tax. Absolutely, Joe. Property taxes are not low. I remember that like it was yesterday when we lived in Bernie. Woo! That was painful, going from Shenandoah Valley, Virginia, on a $140,000 home. No, I think it was even less than 120, to Texas with a $320,000 home in Kendall County. That was painful. Any recommendations for Reed's, the special need trust? Yep. Reed, it's back there someplace. I would start. Who asked me that? Michael with Beyond the Grave. Let's see here. It's up there someplace. I would start with Beyond the Grave by Jerry Condon, Condon. Without question, Jerry Condon, Beyond the Grave. And I'll put a link in the show notes. And if you buy it through my link, I get paid big bucks. I'm just joking. I mean, whatever. But I have it around here someplace. This is the best book on estate planning I've ever read. Easy to read because he talks about stories of what you need to be prepared for sure. Left Kentucky a year ago, 6% sales tax, but state income tax. Now I live in Tennessee with no state income tax, but 9.75% sales tax. Yeah, no, understood. Lots of people are very keen on making Tennessee a libertarian mecca, like they're doing in New Hampshire with the Free State Project, which is pretty cool. So a lot of my libertarian friends are saying, leave Georgia, move up here, trying to recruit freedom-loving folks from California and whatnot to move to Tennessee to make it a southern version of the Free State Project that New Hampshire was trying to do, but it seems that is being displaced by wealthy Bostonians moving up to New Hampshire, which is too bad because they're taking their politics with them. Even in the great state of Maine, where I'm from, that same thing happens. So the Bostonians with their lots and lots of money move up to Maine, drive up the property values for everybody else. And of course, the natives get displaced. Not quite gentrification, but pretty doggone close. And then they bring their politics with them. That's bad. So keep Tennessee. Shh. We just want like-minded people to go there. We don't want Californians bringing their high tax stuff in California, anti-guns. We want them to stay in California so free people can be free in some place in the world. That's my political rant for today. My man Devin did a video yesterday. He didn't want to be too political. I was just chuckling because, look, man, when you talk about taxes, you can't help but be political is all there is to it. Regarding a pension option, should I take a survivor option to provide 50% to wife or don't take some kind of life insurance policy. I hear that all the time, TMK, especially in the military. All right. The military is like, oh, no, don't take the survivor benefit. Just buy a life insurance policy. Yeah, I've heard that so many times that flipping pisses me off, pardon my French. And what they'll say is, look, if she dies before you do, then you paid all that survivor benefit premium. I think it's $300 a month for nothing. And so you could have used that money for other things. Yeah. But what's the likelihood of that happening is not high, because usually it's a man who will die first. And also, what's the likelihood of that life insurance staying in force while you're dead? Not high too, because the life insurance premiums go way through the roof. It doesn't have enough cash value to fund it. Don't even get me started. Not a fan of that at all. I don't care what anybody says. There is not a good method of doing that that's better than a survivor benefit for the military, which is 55% of the benefit. In this case, a 50% option. I would see if they got a joint life survivor, 100% option, a T. If they have a joint life survivor annuity with a 100% option, that's my preference, frankly. I bet it won't be that much lower than the 50% survivor benefit option. I really do. Look, man, I got no problem with life insurance. I got life insurance. Everybody should have life insurance. But when they start using life insurance as a way to, it's why are these guys so keen on it? Because they get paid huge commissions. I mean, if they weren't getting paid huge commissions, they would not be so keen on it. It's just all there is to it. And that's the thing with those annuities with 10% bonus structure and the life insurance. Look, you can, I guarantee, if they had a regulation, and I don't want regulation, I'm just saying if they did, that said you couldn't sell life insurance and get 63% of first year premium, which is the commissions these guys get. 63% of first year premium. Just keep that in the back of your mind. So if you're dropping $50,000 in some kind of cash value life insurance, the first year commission is 63% of that $50,000. Guarantee. If they said, no, we're not going to do that anymore, you're going to get paid a trail, 50 basis points, even a 1%. That all of a sudden you find a whole lot of people who are loving life insurance would not love life insurance as much anymore. Guarantee you. And that's the thing with life insurance, is regulated by the state. Each state has its own fiefdom of regulatory agencies. At least the investments have the feds, which is, I don't like that. But at the end of the day, it's a uniform regulatory environment. Each state on the life insurance does. And so because of that, guess who staffs the life insurance commissioners? Do you think it's average Joe Schmo, or do you think it's someone who has a affiliation with the life insurance industry? Take a wild guess, huh? And when that person leaves the state commission, where does he go? Just like the revolving door we see in Washington, D.C. It's freaking nuts. So that's my opinion on that, TMK. Go with the benefit and be done with it. Man, I got a guy from Morocco on board. Right on, man. Go Texas Tech. Good evening, Josh. Yeah, hey, I'm going for UVA money, but I have a sneaky suspicion. I already said it. 6358 Texas Tech. And a guy I used to work with from Morocco named Mohammed when I used to manage a bar, wait tables, manage a bar. Mohammed was a great guy. He was, man, one of the freaking hardest workers I've ever met, man. That guy, never missed a shift, always showed up on time, always stayed late, never complained. My Medicare Advantage plan is $35 per month in New York. Does that have Part D prescription drug on there? We want to make sure it has Part D as well. And I bet it probably does, but I don't know that for sure. So, I mean, you get $35 a month Advantage in New York State. It's really specific on your county and zip code of what it comes down to. So that's good. Curtis Brooks, 62. I think I need to get the health insurance that covers long-term assisted living. I think I need to get health insurance that covers long-term care and assisted living in nursing homes. Health insurance that covers long-term care. So you talk about long-term care insurance? It sounds like you are. That might be the one case you look at a life insurance policy, Curtis, because they do have these riders, 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 that provide you a benefit for dying life insurance or going to skilled nursing care, even assisted living. So I'm a pretty big fan of those things for sure. I'm drawing a blank her name. I'm going to interview her she just interviewed me for her podcast, her YouTube channel. Boomers Benefits is our YouTube video. I'm just drawing a blank with her. Danielle Howard. That's it. Danielle Howard. Boomers Benefits, I think. And I'm going to interview her next week, I believe. And we're going to talk a lot about that kind of stuff without question. Look at J, my man Jaeoh, J-O out of Michigan. He just had written a blog post on this exact concept about buying a life insurance policy with riders for long-term care, skilled nursing care. And just look at J-O's website and just look up J-O. He had written the book, Maximize Your Medicare. So it's a good book to buy, but he knows everything about this stuff. And then Danielle, she's out of Texas, out of Fort Worth. So I got a guy up in Michigan and a lady down below, that had different perspectives on where they are in the world in terms of long-term care, medical insurance, and certainly Medicaid plan or Medicare planning. Excuse me. Stumbled on this channel by accident. What part of let's see. What part of financial is this about? Business, etc. Financial planning, my man, Jeremy. Financial planning. So if you maxed out your IRA contributions, it's true they can no longer contribute to. Yes, yeah. So if you got one of the you can put. You got 100% can go into one, or 50% can go into both, or 25-75, but it can't be more than whatever the feds allow today. So it's all, or it doesn't have to be all or nothing, but you can't go over that amount. That's right. Okay. As Curtis says, I'm getting ready to retire. So last week I moved 40% to cash with the rest in S&P 500. Nah, no, I don't think you're too heavy in cash right out of the gate. No, sir. I got no problem with that. I'm heavy in cash right now too. I mean, just all there's not because I'm timing the market. I bought my VTV, but at the end of the day, if I need to draw on income to put food on the table, I need to have cash on the side. So I did buy my value index for sure, but I still have a decent amount of cash, Curtis, in case the market goes down. I can't afford to have that money out. I mean, that's money that will be taken from me to put food on the table if things go south. We are 66 and 64 and have half our money in cash, but also a big part 403B and 401k. Yeah, quite concerned about the tax burden. Yep. Do you think yeah, absolutely. Jackie, do you still have time to avoid it? Yeah, absolutely. You just got to be moving on that sucker like white on rice for sure. I mean, I don't have a 1040 with me. I'd look at the bottom line. I mean, look at your taxable income, not your AGI, your taxable income. Where do you stand relative to the next tax bracket? I mean, just look at that, because come 70, it's all for naught. You will pay. You will pay. So if you could pay a little bit more now to avoid a lot more in the future, and you're pretty close to the golden years of tax planning. Not quite there, but pretty close. The golden years are really 60 to 62. You get plenty of time. Absolutely. Absolutely. They need to stay out of Texas all guns up, right on. Franklin, Monty, stay out of Texas. I think that ship has sailed, man. California, Texas is California southwest or southeast, I guess. If you had $50,000 in debt at 5.5% and $50,000 AT&T stock paying a 6% dividend, would I sell the stock to pay off the debt? Yes. Of course, it depends on what my capital gain is. So if I had a zero cost basis, that's going to cost me, that'll be $50,000 of long-term capital gains, presumably that you've had it for over a year. So that'd be 15% on $50,000, whatever that is, 7,500. I mean, but yeah, I would in 2 seconds flat. Let's say I had no cost base, I had no upside gain. Hell, if I had a loss, it'd be even better. Richard, I'd do that in 2 seconds flat. My presumption, I'm going to predict, Richard, that your wife is sell the stock and you're saying hold it. That's going to be my bet right there. Prove me wrong. And I will default to your wife as the smarter of the two here, if that makes sense. What's up, Victoria? Geez Louise. What's your option of funding a special needs trust with a guaranteed, the G is a critical thing there, Michael, the guaranteed universal life insurance. Yes, as long as it's guaranteed never to lapse. We don't want that sucker lapse at 95. It will say it's guaranteed till 95. No. We want that sucker guaranteed to pay out when you die. If you die at 80, it pays out. If you died at 150,000 years old, it pays out. So yeah, that's absolutely the way to go. Guaranteed universal life insurance, 100% is the way to fund a special needs trust, bar none. No, or a second to die policy as well. If you're married, a survivorship universal life insurance policy would be the same thing. Survivorship guaranteed universal life insurance will actually be cheaper because it's covering 2 lives, but it'll only pay out on the death of the second spouse. So if there's you and Mrs. D'Amico, presumably Mrs. will, you'll predecease her, and so she'll survive you, and then it won't pay out until she's gone, which means because there's 2 lives to cover, there's more premiums for the insurance companies to collect, so it'll be lesser on the premium. Hope that makes sense. But yeah, no, that's absolutely the way to go. Curtis, one last question. I'm using Vanguard as a money market. It seems to me I could use a bond index fund as the same as no. Heck no, no. Do not use bonds as a supplement, as a replacement to money markets. No, no, please, for the love of the good Lord. Remember, I don't want to get into it, I will. Bond index fund. What's the biggest constituent of the bond index? Treasuries. 70% of the portfolio is treasury bonds. Why? Because the bond index fund is market cap weighted. The companies and the countries with the most debt are the biggest constituents. So you're buying up companies and countries that have the biggest debts. When they have lots of debts, all right, that is risky. Now, I guess the treasuries are not going bankrupt because they can print their way out. But at the end of the day, you're still only getting, what's the 10-year treasury right now? Last time I checked, it's 2.5. Let's take a look. So 10-year treasury right now, Curtis, is 2.51. 2.51. The money market at Vanguard, the last I heard, was 2.45. All right. Both are going to be taxed as ordinary income. But theoretically, the money market could break the buck and go below 1. That's never happened at Vanguard. Could, but it never has. Presumably never will. What's the risk on bond index fund? Well, there's significant downside risk. So I wouldn't touch that with a 10-foot pole. No, sir, Bob. I'd rather do a CD instead. Part D is included. Right on, D. Okay, well, I got no qualm with that. My wife and I own a bar for 26 years in Dallas. We had a good time. You still own the bar, Monty? Insurance Riders got it. Yeah, I managed the bar for many years, and it was a brew pub in Arlington, Virginia, and a lot of good friends of mine I'm still touched with. But I like drinking beer. Never liked hard alcohol, but man, I could drink like a freaking crazy man. Like I said, we used to brew. I didn't, but we had a couple of brewers that used to brew like 10 beers at one time in there, and they had this IPA that would, oh man, I could drink the heck off that. Not good. If you have a hankering for some alcohol and you drink a alcohol product that you enjoy drinking, not a good sign. We have to pay tax on a sale of the AT&T stock. Well, okay, you're asking how I got you. Copay is $5 for regular. Yeah. Okay. So there you go. Medicare Advantage. And the only thing about the Medicare Advantage plans, Dave, and as you're probably aware, is a network. And so if you live in a rural county, it's probably hard to find a doc. If you're in a populated county, it's probably not going to be hard to find a doc. At least that's what I saw my own aunt. We could find docs easy, all kinds of them. Easy. Very, very cheap. Medicare Advantage is good. It's just if you plan on doing a lot of traveling, or if you're in a rural place, it's not as good because you're a network. That's all there is to it. So Medicare Advantage plan is the drawback to the Part D prescription drugs. The drugs they cover changes every year. So just every year, just talk to a broker and say, hey, I'm taking whatever I'm taking. I don't even know what drugs there are. Ibuprofen, whatever. Is that covered this year? Just make sure your plan still covers that stuff because it changes all the time. You got to keep that in mind. Yeah, I told you, Richard, man, that's why I say women make better investors. They're more conservative, generally speaking, when it comes to money. Now, that means they're better investors from the retirement perspective, but they're worse investors from the accumulation perspective. I'm just telling you, man, when it comes to decumulation, women are more conservative, which is better. When it comes to accumulation, women are more conservative, which is worse. They don't take as much they don't take as much risk when they're building the assets, and they take less risk when they're taking the money out, which is where you want to be less risky. But when you're building, you want to be as aggressive as you can because you're working, and that work is a bond. I mean, you use your labor as a bond. So not shocked. So Richard, I'm going to go with your better half in that case. My wife has always been smarter than me, way smarter. Yeah, other than marrying you, Monty, that's why I tell my wife too. I said, why the hell you married me? I'm glad she did. I'm grateful for it. But when it comes to the brains, not here, it's there in terms of, get stuff done. Now, could she become a financial planner? Hell, if she wanted to be, absolutely. But she also want to raise 4 kids and have to deal with me. Bilbo Baggins, man, what are you doing here? You should be in the Shire. All right, so Bilbo Baggins says, I'm 55, wonder if it makes sense to retire now, living off savings about 6 years while converting. Yeah, absolutely makes sense, Bilbo, without question. Living off savings for about 6 years while converting my 401k to a Roth. Yep, man, no qualm with that at all. None at all, Bilbo. Rosa Ponte says, I have $600K in a 457B plan and an annual pension of $77,000. I am 60 and retired this January. What's the best strategy going forward to save on taxes? Well, all right. And if you're single, Rosa, I bet you're a teacher in New York. I'm going to predict you're in New York. I bet. If you're single, you're going to have to start moving money. You don't have to. I'm assuming you don't have Social Security as well. So I'm going to assume you're not having Social Security. That's a teacher's pension and you live in New York State. Yeah, ex-court employee. Okay, so in New York, ex-court employee. So did you pay into Social Security system or no? I'm going to assume you didn't. Oh, okay. All right. So then you need to start moving money ASAP out of your Roth, out of your 401, your 403, your 457 plan, excuse me, and converting it to a Roth. You're going to have to bite the bullet to some degree. I mean, if you're single, it's going to be a tax burden for you for sure, because 77K alone right there, you're already in the 22% tax bracket. All right. So the difference between 22 and 24 isn't much. It's just not. The difference between 22 and 24 is much. So if I were you, Rosa, I would be doing this. I would be moving over the next 10 years between now and when you're 70 and when you take your Social Security, I would be putting, roughly $60,000 a year into my Roth IRA. Now that I don't know what that's going to end up doing. I mean, from your tax perspective, I'm going to have to let you figure that out. But if you think about it in the back of your mind, how can I get that $600,000 as low as possible by the time I hit 70? So now I don't have any required minimum distributions because it's all in the Roth, and I'm now living on my pension and my Social Security. Does that make sense? And because your Social Security will still be, there's nothing you can do about this. You're going to pay 85% of your Social Security benefit will be subject to taxation. There's just no other way around that because you have such a high pension. But at least you won't have RMDs. All right. So you're saying I'm going to pay a certain tax threshold essentially for the rest of my life. But if I don't do anything, that tax threshold will be lower now, but it's going to be significantly higher in the future. So hope that helps. But, it's a good position to be. That's one drawback about pensions, frankly, is that they do minimize some of the Social Security planning we can do from a tax perspective. Lots of docs. Yeah, all right. Right on, man. I can never go any. Yeah, so if you got lots of docs in your area, it's hard to argue with Medicare Advantage, especially like my man Dave's paying $35 a month, and that includes Part D. Now, it still pays Part B. All right, don't forget Part B is still going to be paying for it. But literally, that's a pretty big deal for that Medicare Advantage plan in New York with Part D, with docs everywhere. So no problem there at all. Okay. Well, I keep my liquid cashes at Vanguard Money Market. That's what I do, Curtis. Worried about healthcare and retiring before Medicare. Can we poll here on how many everyone pays for healthcare? How much everyone? 46? Oh, 46 years old. I don't know how to do that here, man. I'll put a poll out there, my waste of time. I won't waste your time. I will put a poll out there and say, how much do you pay for health care? Yeah, I guess, well, it's probably, I don't know how to do a poll here. So I have to do it on the, I will put one out there. I'm actually interested in myself. About 700K in TSP 62. Should I convert any of this to a Roth? Yeah, absolutely, man, without question. How much? I don't know. You'd have to look at the tax code relative to your financial plan for sure. Spent some range time today with my, all right, a couple firearms there. So my man Rexpo probably doesn't live in California, or else the good governor would have him behind bars. Even though they did get rid of that stupid magazine ban, thank goodness. That's good. That's a win for freedom. We'll take it. Well, okay. Mr. Andy CM, because of you, I retired from my crappy old job at age 64. The 4 quadrant convinced me I could retire. I have no debt, I have a pension. Dude, that's freaking awesome, man. Proud of that. I love it. The fact that I had an impact on you to quit your crappy old job and retire to enjoy life is, man, I love it. That's freaking awesome, man. Congrats. But you deserve it. Hell, 64 years old. It wasn't like you're sitting around eating Cheetos, freaking playing Minecraft like these fools about, you're doing something. So good on you. Which my man, Shaji, George, which month of year is best to retire regarding more benefits? I don't know. I don't know. That's really situation dictates there for sure, my friend. I have to go work that crap old job. I'll finish watching later. You got Clint. In fact, I am calling it a night myself because the game is about to start if memory serves. Yes, it is. I think it might have already had tip off. I'm tired, my friends. Video suggestion from my Rex Bro. Already retired, but afraid to spend for my 401k. Yeah, right on, Nancy. No, Rex Bro, that's a big deal. A lot of people are dealing with that as we speak. I think it's spot on, and that's a scarcity mentality, if you will. I mean, that's one that says I'm afraid to run out without recognizing who got it to you to begin with. But people have look. It's easy for me to say. You piled away all this money. You're like, man, I got this freaking money. I don't want it to dive into it. And I have an article I'm going to read for you that talks exactly about that. And one of these videos I'll do over the next couple of days is academic research on that. It's scary, but all right, game is on. I'm going to run. See you guys. Appreciate y'all being here. And thanks again for coming on board. We'll see you now.